right, good afternoon, and welcome to Stonehearth Capital Management's quarterly update webinar series, CIO's Corner, with our Chief Investment Officer, Chris Gauthier. My name is Amanda Sylvia, and I'm a paraplanner here at Stonehearth Capital Management. And before we dive in, I just want to go over a few housekeeping items. Please use the question and answer button at the bottom of your Zoom window to submit any questions you have throughout the course of the webinar. We'll aim to address as many as possible at the end. But if we do run short on time, either Chris or myself will follow up with you afterward to just ensure that your questions get answered. I'm thrilled to introduce our speaker. Chris Gauthier is Stonehearth's Chief Investment Officer. He has over 25 years of experience in investment management. He oversees our firm's investment policy and strategy, which includes asset allocation, risk management, research, and portfolio management. Chris, thank you so much for joining us today.
Thank you, Amanda, for that great introduction. And good afternoon, everyone, from a soggy New England. Thank you, everyone, for joining me today. Well, it has certainly been a very exciting start to the new year, right? Nothing's very exciting. To me, that word of 2025 so far is uncertainty, right? Impact it has not just on financial markets, but really all aspects of the economy and our daily lives, the news cycle. Given the nature of our business, Stonehearth Capital Management, financial, we're going to stick with the impact uncertainty has on the economy and financial markets, right? And we'll leave the others to discuss the political and social impacts. So today, I want to go over what we're going to be looking at in this presentation. So today, we're going to take a brief look at Q1 performance. Then we're going to move on to tariffs, kind of look at the why, the who, and maybe look at some unintended or maybe intended consequences, followed by the current investment environment, and really end with how you should be positioning portfolios in this environment. And as always, trying to find the signal through the noise. So looking back at Q1, with everything that's happened since Liberation Day, it's tough to remember. We were not in a great place from a financial market performance standpoint. The first quarter of 2025, you can see the different asset classes on the screen, really was marked by the return of volatility. We had a brief rally to start the new year, uncertainty started creeping in, and the market's focus really shifted to tariff recession concerns. But in the quarter, financial markets were led by traditional safe haven assets. Those are in yellow. That's gold, commodities, things that do well when uncertainty creeps in or when we expect some stagflation to happen. In equity land, using international equity, which is recognized by the green bars over here, really ruled the roost, posted a positive return. Really based on a weaker dollar. You can see that all the way to the right, down almost 3% in the quarter, which helps international assets when it gets translated back into your home US dollar currency. When they had better valuation support coming in, which helped them weather all this uncertainty a lot better than US equities, which we see in blue, which kind of trailed all other assets in the quarter and had one of its largest quarterly declines. Really since Q3 2022, we haven't seen performance this bad in US equity land. So again, coming in to this liberation/tariff noise, we really weren't in a great position. We're seeing some rotation already in markets. But thinking about tariffs, hearing about the current investment environment, we talked about the word of the day is uncertainty. I really think this image captures it best, right? Investors, businesses for that matter, just don't know what to expect on any given day. Policy changes from social post to social post on a whim. It's hard to operate and make decisions. I was doing this presentation. I must have ripped it up 8 or 9 times already and started all over again based on a social post or a tweet or anything out there in the marketplace as the data kind of changed. It's hard to operate and make decisions, in this environment. And think about, never mind just a presentation, think about a CEO trying to invest capital. Should I open up a new warehouse? Should I open up a new manufacturing facility? It's going to take me 5 years to build, cost me millions of dollars, and I don't even know what the environment's going to be tomorrow, never mind 5 years from now, and the payoff period is 10 years. Right? So again, it's tough with information changing so rapidly. And I get it. We always have some level of uncertainty, right? The future is never 100% knowable, but the deal with this, it's just risen to historical levels that we really haven't seen in a while. We are pretty much since the days of COVID. And the negative impacts of this, I think, are being felt and will be felt for a very long time. So with these tariffs, right, really being the biggest bear in the room right now, I thought it really would be helpful to take a closer look, at why. Why is he implementing tariffs? Why does the administration like tariffs so much? Who are we really going after with these tariffs? And again, talk about some potential unintended consequences of this policy. So let's start with the why. Why do we want tariffs? Well, President Trump and this administration believes we are being ripped off, right, due to buying more goods from other countries than they buy from us. What is called the trade deficit. And that's what this blue bar on the left is showing. It's a trade deficit going back to 1974, where it's pretty much zero. You see a big rise in the 90s. And then really when China joined the World Trade Organization right around 2000, 2001, you really see the big lift up in the trade deficit. And you look on the right, you can see the countries that we have the biggest trade deficit with. Who do we buy the most from? Usual suspects. You can see China leading the way at 285, followed by the European Union, and then Mexico and all others. So again, this is the why, the belief that we're being ripped off because we buy more goods from them than they buy from us. So that's the one reason the why. And I do think the whys are dual mandate, and the other why is revenue. We need it. No doubt about it. We're looking at federal debt as percent of GDP at all-time record highs. This is going back to 1940 out there, and if you look at the current environment, we're going to keep spending, right? Based on history, demographics. There's no really need, there is a need. No one really wants to cut spending, right? There's no incentive to cut spending in the government, and it just keeps growing and growing. So again, this is just what we have now. This is the current policy. And you got to remember, right? We also have $4 trillion in expiring tax cuts that want to be extended. Campaign promises that were made: no tax on Social Security, no tax on tips, increasing the SALT deduction, right? All this adds to this debt. So again, there really is no appetite out there, no signs of an appetite for slowing this down. And we need to have revenue to pay for this. So that's the other piece of the puzzle in terms of why this administration likes tariffs so much. They need the revenue. I'm now looking at the who. I think this is a really interesting shot. Again, and taking a step back, looking at this picture, you can really see try to get to more the end goal of what the administration is trying to do. So, see who's targeted. Definitely Asian concentration. You can tell by those deeper reds, that's the higher the tariffs. You can see what that is. Really likely going after China, right? So making sure China can't ship its goods to another country and then get shipped over to the US to avoid tariffs. So really an Asia-centric focus. So when you take a step back and look at the 1,000-foot level, right, it really feels like a new world order that they're trying to establish here. More of the regional view rather than a global view, bring things back to the US, bring jobs back to the US, bring more trade to the US, and more just a North American slash US focus is really what they're trying to do with these tariffs. So looking at history, there is some precedent, right? We have had tariffs before. We don't want to talk about the Smoot-Hawley tariff. Everybody knows that about the Great Depression. But it's interesting to know that, again, that green dot up on the right, estimated with 4.2, was put on hold. It was only put on hold for 90 days. July is fast approaching. Haven't seen any deals made yet, although we've heard a lot of announcements that they may make deals. We haven't seen any really details on that yet. Treasury Secretary Bessent was out there today testifying before Congress saying we're going to see some this week, maybe. But again, not a lot of details. But even if we get those deals and the tariffs go back to just the normal first ones he went with, that's prior to the 4.2 announcement down here on the blue. We're still going back to 1940, right? So we still have a long history of not having tariffs this high. And it can't be good for international trade. And I'm really sure we do not want to go back to an economy that was based like it was back in 1940. So that's the history. Now, unintended consequences. Direct foreign investment, which is that yellow area up top, really is the mirror image of the current account, which is that blue area on the bottom. The current account is really just the trade deficit, right? It's just the trade deficit. So the direct foreign investment is just a mirror image of the trade deficit. Trade deficit is not a one-way street. There are benefits to the US from running an account deficit and buying goods from others, other than the fact that they can, make it better or make it cheaper and all that. But we pay for dollars for these goods, right? And they need to be parked somewhere. And that parking somewhere is that direct foreign investment. Where do they go? Well, they fill up with treasuries, keeping rates low, which we know we need based on the amount of debt we have, right? Think about supply and demand. The more demand it is for treasuries, the lower the rates. It finds its way into all types of other assets too, like stocks. So you can see in the next chart how the foreign ownership of the U.S. stocks has risen since the China entered the World Trade Organization. We had more global trade, and then trade deficit really increased. Fully almost 18% of the US stock market is owned by foreign investors. And again, what is the impact of this? Well, remembering that economics 101, I have money, I'm investing, I demand. So demand is for US stocks, US stock prices go up, that helps the US stock market rise. It also works in reverse. If I'm a foreign investor and I don't have as many dollars to invest, or I want to move away from a country that's putting tariffs on my country, then I may sell, and that's supply, and that'll hurt prices. So again, you could see some selling pressure. And I think we saw a little bit of this in Q1 2025 when we saw that first chart we looked at performance. You saw a little bit of that rotation, investors moving money out of the US into their home countries. Another unintended consequence is refinancing risk. This is a very scary chart. And what we're looking at here is maturity of US corporate bonds issued 2020 and 2021. This debt needs to be refinanced, right? Look at that red bar, is almost 700 million coming due in 2025 and 26. But over the next 4 years, that's 1 trillion, and it needs to be rolled over. And you need to finance that. You need buyers of this debt. And if there's less dollars around from foreign countries trying to invest in this debt, you may end up with higher rates and kind of hurt the economy. Another unintended consequence is another big borrower out there, not just corporations, is the federal government. And what we're looking at here is interest as a percent of GDP. So this is the amount of the percent of the GDP that we pay every year just to pay off the interest. So this is not investing in Medicare. This is not Social Security. This is not defense spending. This is just paying interest on the debt. And you can see it's heading in the wrong direction. It's almost at record high at 3.02%. And we look at what the current government pays right now, the whole entire weighted average of the debt, right around 3.2.8%. And we can see from the look of Treasury rates, 2, 10, and 30s here, the current rates are not helping, right? Direct foreign investment disappears as the trade deficit is removed, removing downward pressure on rates and our borrowing cost, right? So really talk about cutting off your arm because your finger's broke. You can see the impact of that. And this is when he put a pause on the tariffs, when we saw those rates rise here a little bit, getting, especially when the 10-year, which is orange line, hit almost 4 or 5. Again, so that increases that borrowing costs. As you can see from here, it's already at record highs, and that can't go any higher. It's unsustainable. So again, let me talk about unintended and intended consequences of all the tariff noise out there. So that's tariff 101, kind of what's happening, the unintended consequences, and kind of how we're thinking about that. So let's leave this world, the tariff world, and see what the current data is saying in the economy, in the equity market, fixed income market, and as always, finding the signal through the noise. So on a better note than all this uncertainty, the economy was, contrary to what you might have heard, the economy was in a very good place coming into Liberation Day. We're looking at real GDP, and you can see that that dotted line is trend growth, and we're far above that. So good, really driven by that consumer, which is, you can see on the right-hand side, is almost 70% of the economy. And we've talked about previous presentations where the consumer is really hanging in there and spending, and we've been seeing that up until Liberation Day. And we look at the prior history of GDP, you can see we're growing at a pretty good clip. So we're in a very strong point coming into this. And that matters, right? Because the stronger you come into something, the more body blows you can handle. Think about a boxer out there boxing. First round, has all its power, is very good stance. Take a couple body blows, doesn't really move him anywhere. If he's round 8, a little bit tired, a little bit weak, a little bit off balance, and 1 or 2 body blows and knocks him down to the canvas. So the stronger position you are, the longer you can last. And the economy is in a very strong position. Even with the latest GDP print, which just released on April 30th, so we've updated this data as of April 30th, you can see all the way over to the right, we did have a negative print on GDP. But as always, when we look at economic data, the devil's in the details, right? The weakness we saw really was driven by front running of the tariff impact, right? And that's this purple line. So this is the net exports. We're down 4.8%, and that's just imports minus exports. So If it's a negative number, we're importing more, and that hurts GDP. And you can see that was where the negative print came from. But when you look at other parts of the economy, consumption, that's consumer, 70% of our economy, that was up 1.2. Businesses are still investing, 1.3. Government spending is coming down as expected with Doge out there doing, hopefully doing something there to help the government spending. See that coming down. Residential up. So again, other than the front running of the tariffs, we're still in a very strong economic standpoint. And we can see that from the labor market. So looking at here from two different points of view. We look at the blue line, that's that wage growth, right? That's how much wages are growing. You can see that as of March 2025, it's at 3.9%, right around its 50-year historical average. And when we see in a few charts later inflation, that's below three, you actually have more money in your pocket on aggregate. Not everybody, but on aggregate, workers have more money in their pocket and at the end of the day because wages are growing faster than inflation. And we're also in a very good standpoint from an unemployment rate. We're at 4.2, which pretty much all economists agree is pretty much at full employment. If you want a job, it's pretty much out there. So again, got a very healthy labor market that's helping the consumer, which in turn should help the economy since that's 70%. Now, what could change that is sentiment and the tariffs, and we are seeing that. And I'm sure you heard a lot about soft data and hard data. When we think about soft economic data, think about attitudes, expectations, opinions, feelings. And that's what we're looking at right here. So if we look at the top hand left side, those are surveys. You can see that going below 50. But if you look at the bottom left, consumer confidence from the University of Michigan and the Conference Board, just cratering, falling off a cliff. Look at the top right-hand corner, business confidence, definitely falling, showing the same insight that people are getting more nervous, uncertainties creeping in, confidence is weakening, less confidence, less spending. Look at the CapEx intentions on the bottom right, home builder, showing the same type of story. All the soft data is pointing to a weaker economy. But again, it's not actually the hard data, it's not actual events. The reason we're so concerned about the soft data is that soft data can set future expectations and shape the hard data that follows. Just think about yourself. If your confidence wanes in your a job or in your wage growth, you may not spend, and just multiply that by the millions, hundreds of millions of people in the U.S. You can see where that can grow. So, unlike the hard data, the soft data is definitely showing signs of weakness. And we're seeing inflation, which we talked about. Again, wage growth at 3.9. We look at the top headline consumer price index. That's the CPI that gets quoted. This is as of March, as we haven't had the April numbers updated yet. 2.39%. So you have more money. So again, looking across the price spectrum, which is the top three charts, top one is all the goods. The middle blue chart takes out food and energy, and the purple chart is what companies are paying for at the beginning of the production cycle. All have shown massive improvements. It's been great since 2022, right? Glad we're not back up at 9%, but we're still a long way from that 2% goal that the Fed says is its mandate. Um, so again, tough to see your way to lower rates when you have inflation not at your goal, right? So you don't want to lower rates there. You have a very healthy labor market, so no reason to lower rates. Really tough to see your way to a rate rise. A rate cut in this. Doesn't mean rates have to rise. It just means we don't see a rate cut. You do the problem the Fed also has is that last chart in green at the bottom, and that's the expected change in inflation rate, up 4%. Huge rise. And this is just, again, that soft data. This is asking investors what you think inflation is going to be in 5 years. Problem with that is it's a very watched number by the Fed because that creates a feedback loop. And what a feedback loop is, if you think about your own situation, if you think prices are going to be higher and you need to buy something, you want to buy it now. So you buy it now before the price rise. Well, everybody's doing that, which creates more demand. More demand does what? Increases prices, and you can see where that feedback loop comes and just sentiment turns into real data. So again, Fed's meeting today, they're going to close out the meeting tomorrow, have an announcement. We don't expect any rate cut, neither does the market. I think they're pricing in 98% chance the rate's going to stay at 425 to 450. They're going to be data dependent. And again, we saw the data. Doesn't look like there's a rate cut. So the market right now is pricing in 3 cuts in 2025 or thereabouts. See where the market might be set up for being disappointed, given all the data we're seeing. And when we look at the global market, just like the US, it was in pretty good place as well. Now we're looking at manufacturing services, purchasing managers index, a little bit different data, but we want to make apples to apples data across all these countries. And you look at that right-hand side, you see a lot of green, a little bit of orange, but mostly a lot of green, which means most of the global economy was in a very good spot coming into this, with the hope being that they're better able to withstand all these shocks and the uncertainty in the marketplace, and there's not necessarily a recession guaranteed in the future. The probabilities have increased, which we'll kind of look at in a little bit. But again, does not guarantee a recession given that we came in with such a strong economy. So what was not strong coming into this was the U.S. equity market. We did see the poor performance in the first quarter of 2025, and we're also starting from a very high valuation standpoint. And what we're looking at here is forward PE ratio going back to 1994. So this is just taking how much investors are willing to pay for a dollar of earnings. And you can see the averages going back there that usually on the past 30 years, investors are willing to pay 16.9 times for the U.S. equity market for $1 of earnings. You can see when it gets above a one standard deviation, you really start to get nervous, and we're there pre-COVID, and then we're also there just recently, and we're starting to come down. But even with this recent sell-off, and this data goes to April 30th, not the end of the quarter, we did see some improvement, but really not enough to get excited, right? We're not seeing those average valuations or cheap valuations. And we're seeing really across all different valuation metrics when we look at the box out here, not just in the PE, but in the Shiller's PE, which looks back 10 years. So it takes out the effects of the business cycle and inflation. Looking at dividend yield, price to book, price to cash flow, on any metric, the US equity market is very expensive. But what good thing is, it's not just about the S&P 500. Investors have other choices if they know where to look. And luckily, there are other places we can invest that have better valuation support. And again, talking about the uncertainty in the world and taking body blows like that boxer, if you're starting from a better position or a position of strength, a better valuation, you can withstand that better. And we saw that in Q1 2005 with international equities, which are right here, are holding up better than the S&P 500. And we're just looking at the similar statistics, PE, next 12 months PEs, price to book, price to sales, all valuation metrics that people use to value different assets. Pretty easy. Green's cheap, red's expensive. Anything without that is kind of in the middle. And you can kind of see where your eyes go to where you're finding some of that decent valuation support in some of the small cap US stocks. But again, on the balance, you can see Europe, international, just trading much better valuation support and remain attractive on a relative basis compared to other assets. So turning back to the S&P 500 and really looking at the more recent performance. Now, what we're looking at here is a chart, the S&P 500. So these candles, called the candlestick chart, that's the price movement in the S&P 500 on a daily basis. See the big sell-off, the big announcement the tariff's going to be held off for 90 days, and the current performance and the rise in the market right now as of May 2nd. When we look at this blue line, that's the 50-day moving average, so a shorter term moving average, and this pink line is a 200-day longer term average. You can see that death cross when the market sold off. You can see that, it's been a very healthy development recently, but still not giving the all clear signs, right? It hasn't really reclaimed that 200-day moving average. It's getting close, but it's not there. And there is an old market adage that I truly believe in, and nothing good happens below the 200-day moving average, which means most of the massive outperformance you get is when the market's above the 200-day, and we're not there. So again, not giving that all clear yet. And so why don't we think we're given the all clear out of the woods yet? Well, it's really based on history and data and the studies we've done. And what we're looking at here is data from Goldman Sachs. We're looking at bear markets and the recovery since 1800s. It's over 35 events they have listed here. You can look on the average, the sell-off is around 30%. And if we kind of go post-World War II, it's a little bit less. We're still right around that 30%. Where you see the difference in different types of bear markets is the length. So when we look at structural, those are the most damaging. That's the global financial crisis. That's a structural decline. And then we have cyclical and event-driven. And we can see the decline is very similar, but when we move over the average length, you can see the cyclical is much more damaging and lasts a lot longer. So again, you can see where it's important to try to define, are we in an event-driven bear market? And the event-driven bear market, think COVID, or we more cyclical, think great financial crisis. I'm sorry. Sorry about that. More.com and things like that. So again, it's interesting to see that it's so important to figure out what's going on in the economy, right? So right now it feels and looks like an event driven, but the nervousness is that it could turn into a cyclical bear, right? And with recessions risk rising, you can see that probability increases. And what's even worse is when we start looking at all the uncertainty in the marketplace, the market begins pricing in whatever the latest social post is. So when we get more tariff information or that we're going to start putting tariffs on movies, people start thinking we're in cyclical and sell off the market. When you start getting relief on tariffs, well, there's deals to be had, and you start thinking more of an event driven. So until we get really confirmation that it's definitely an event driven and they're not a cyclical, we're still going to be a little bit cautious here because it's very easily, given where we stand and what we see in the marketplace, for an event driven to turn to cyclical. And you can see where it matters because that recovery period is just so much longer. So what we're really the big worry now is that this is current event driven bear market turns into a cyclical. And with the recent outperformance, I thought I'd put in perspective this recent rally we're seeing. So when we look at bear markets through time, rebounds and rallies, especially this sharp and volatile, are really common features in bear markets. So we're looking at bear markets since 1981. There have been 19 global bear market rallies since the 80s, and the average 44 days and a 10 to 15% bounce, even within this bear market. So again, given the latest rise in the market, you see about up 17%, but less than a month, it's still within the range of what is a typical bear market rally, Now, that doesn't mean it is a bear market rally. This could be the start of a new bull market, right? It doesn't have to go down, but looking at the weight of the evidence and all the data, which we look at our risk models, the risk that it turns into more cyclical, and this is a bear market rally, is more probable than not. And that's what we're looking at. So that's where we stand in the equity market. I'm closing out with the fixed income market. We're looking at spreads here. So this is what high yield companies and corporate companies pay over and above the US government. So how risky are their loans? And what this is giving you a frame for is how is the lending market out there? Are banks seeing a lot of risk? And when we see these spreads widen or these charts go up, then we get a little bit nervous. Banks are saying that they may not get their money back and they're requesting higher interest rates on the loans, which closes out lending and stifles economic activity. We're just not seeing that yet. Now we're definitely seeing an uptick. You can see that right here. The high yield was the more, which is as you would expect, since it's a riskier part of the market. But what we haven't seen is it move above averages yet. So we look at March 2025, these are the spreads different parts of the market are paying. It hasn't gone above its 20-year average yet. So again, being below its long-term averages, it may not be giving the all clear as we're seeing a rise, but it's not pointing to more weakness ahead. So again, this is one thing that's holding us in the market and maybe positive. And another reason why we like the fixed income market, even with this higher for longer environment that we're probably in, it still plays a vital role, having some ballast, but it's the current rate environment. So sometimes we investors, we have short-term recency bias creep in. And all that means is a fancy way of saying that we put more weight on recent evidence than on the long-term evidence. And we look at fixed income, we all have those memories of 2022 not really providing ballast in a down market. Well, the reason being was rates were near zero, right? And we can see that. We're looking at rates over the past 10 years. And you can see in the US Treasury market going from lower risk, the higher risk, it was a very low rate environment, ones we haven't seen pretty much throughout history. But we compare that to where we are now, when we're up at 3.9 for treasuries, 5 for investment grade corps, we have more income. We have more buffer. So even if rates go up a little bit, we have more income to offset that, and it does provide ballast. So again, it's not your father's fixed income market, you like to say, that given the recent rise in rates and how high they are now, up in the fives and sixes, you have more ballast and will provide protection with all the volatility. And we're seeing that play out so far in 2025. So those are the economic environment. That's the equity market, the fixed income market. So let's kind of put this all together, bring everything back. And what we like to do is use our models to do that. And that gives us a really 2,000-foot view of the risk in the marketplace. How much risk, what's being priced in, the probabilities of what's the best way to position portfolios given the risk environment. And the first thing we look at is a Ned Davis Fab 5 model. We've talked about this before. This is 30 different indicators broken down to 4 different categories, which you can see there: tape, sentiment, monetary combo. You can see where each one of those stand: neutral, bearish, neutral, neutral, which turns into a -1. It's interesting. This is the same exact place it was last time we spoke. But there is a big difference. There is months in between, and we can see that in January, this model did drop below 1.5. And when it drops below 1.5, when we look at the bar, the call out chart here, historically, it has not been good for the S&P 500 performance, right? It down 16, almost 17% when the model falls below 1.5. So here she's on a side that something happened in January to push the market into more bearish territory. Um, in order to prevent whipsaws and getting too excited on short-term bear market rallies like we may be seeing now, he would not go positive until it goes above a 1.5, and we just have not seen that yet. So we'd have to go up to here. So again, looking at the Ned Davis Fab 5 model, turned bearish in January and remains on a bearish call for the market. But again, we look at multiple indicators. We also have our own internal model, really built to complement NDR's model, some things they were missing in there. And we saw a similar drop, maybe a little bit more dramatic. We're at -2 last time we spoke, and we're more neutral on risk. Definitely saw a decline down to -8, and we're definitely negative on risk. The big change, you can see down below the technical picture, right? Coming in from a positive technical standpoint when we spoke about the end of the year in 2024, and we see that definitely fell off cliff in the beginning in 2025. Again, using US stock markets, no surprise what we saw, right? Support resistance broke. We saw 200-day moving average break, cycle, the wrong part of the market's outperforming. So overall, more negative. Valuation got a little bit worse. Again, all the uncertainty creeped in, earnings estimates came down, but it's still not a good valuation pitch, and we saw that coming in. What's interesting here is you look at the macroeconomic environment. This is that soft and hard data. We use a lot of hard data in our models, and you can see that's still positive, right? So the economy is still humming along, even with data that matters, right? Again, it's just not looking backwards. We're looking at data that pertains to future economic activity. And as of March 31st, 2025, the economic data was still positive. We're still in a good spot. So that's helping, keep hope in the game a little bit that that it's not enough to push us into a recession. And then qualitative, I don't think anybody would be surprised after listening to this presentation. We move that to negative. There's just so much uncertainty in the marketplace that there's no need to have that anywhere near neutral. So again, if I put that like -8, I think I could. The model just doesn't allow for it. But again, it is having a negative impact on the model. So again, the models are in alignment. Not really a great environment for taking on risk right here or having large exposure to risk assets. So to close out, let's kind of see how this is impacting portfolio exposures, where investors should be investing. So looking at asset allocation, again, this is as of April 30th, 2025 for a moderate benchmark. We may have changed since then. And again, just based on the moderate benchmark, and you can see that, from last time we spoke, we moved from an overweight to an underweight in equity on the quarter in multiple steps. This wasn't one day we just decided to move as the data came in a little bit weaker, that probabilities of a recession increased. The likelihood that we're not in an event-driven bear market, they're more in a cyclical bear market. We reduced risk in our portfolios. Really took it out of U.S. equities where we saw the most risk, the weakest part of the market with the highest valuations, with the less support there. So now we're overweight developed, underweight equities in total, but overweight developed. Again, we saw the good valuation support they have. Reduced dollars to invest in U.S. market, maybe going to international markets, declining U.S. brand, all leading to a weaker dollar, which helps support international asset performance. With neutral EM, definitely like it better than U.S. Maybe not as much international developed with a lot of China exposure in there. China has its own problems coming into this before the tariff mess. So again, it is a kind of playing a game of chicken between the US and China, who blinks first. China wasn't in a great position coming in, so we'll see. But given that exposure, we think it's better to be neutral in emerging markets. Probably no surprise, fixed income, given what we talked about. Good starting rates, downside protection, helps control the volatility. Don't mind being overweight fixed income markets, especially active management. You don't want to be passive in the fixed income given the rate environment, all the uncertainty out there. Opportunistic, we're neutral. Again, no reason to be a hero given all the uncertainty in the market and the disagreement whether it's going to be an event-driven or a cyclical-driven bear market. You really just don't want to be out on a limb anywhere. You want to kind of pull everything in, find where the good valuation support is and control some volatility. So neutral and opportunistic assets. In cash, you're just getting a higher yield elsewhere in fixed income and provide some, better valuation support. So that's how we're thinking investors should be positioned, given the information we're seeing as of right now. So before turning it back to Amanda, I want to go through some key takeaways here, what we've talked about today and what we can take away from the current environment. Well, tariffs, big thing, right? The rhetoric's going to continue. It's going to have a large impact. I wish I had some model to predict what social post is coming out next. There just really isn't. We're at the whims of the current administration and what they want to go out until we get the hard data coming through. The good thing is, consumer and global economy is starting from a position of strength. It may not last. We're seeing some softening of the economy reflected in survey sentiment, and not the hard data yet. We'll have to see. Equities, not so much, right? High starting equity valuations, negative momentum from the sell-off, all put together, reduced attractiveness of stocks. Again, we saw that we moved underweight. And putting that all together in our risk models, right? The weight of the evidence from the multi-factor risk models, both Ned Davis's Fab 5, our internal risk model indicates, caution's warranted, right? In asset allocation decisions. No reason to be a hero here. And lastly, uncertainty has increased in an uncertain world, and invest accordingly, and caution is definitely warranted in this environment. So turning to questions and answers, I'll see if Amanda has any questions out there in the
Hi,
queue.
Chris. Hi, Chris. Thanks so much for all that information. Just as a reminder, some people have already found it, but the Q&A button right here at the bottom of your Zoom screen, you can submit your questions and we'll kind of go through a few of them. The first one I have is we are already collecting some revenue from tariffs. Inflation is falling. I am paying less at the pump and I haven't seen any difference in prices at the store. So why do I keep hearing tariffs are bad?
Yeah, you are correct on your points. All right. Those are all true, but it's really still early in the game. And most impacts to the economy act as a lag, right? You always hear that. And yes, inflation was heading down, but that was before tariffs, and that was as of March. So that was before tariffs were actually implemented, even the 10% things. Um, they were telegraphed by the administration. So we saw, in the GDP numbers, businesses got ahead of it and stocked up, right? So all those goods that came into the US market were before the 10% tariff. So you can get the old pricing. They have goods on the shelves. So again, there is a lag in that in terms of when they order. That can only last so long, right? New orders we're seeing have been canceled in the data, right? Reports of empty ports, say that fast twice. Reports of empty ports and a 65% reduction in cargo ships scheduled to arrive in the US from China really does not bode well for future revenue, right? And if there's higher prices, lack of supply, that's prices, that's inflation, economic theory of supply and demand. So unfortunately, I hear you, I get it. It's just the impact is coming. We just don't know to the degree. It just takes a bit for the full effects to be felt. Looks like end of May for goods we're really going to start feeling those impact to tariffs if nothing changes.
Chris, this next question, I actually have a couple of the same question, essentially. Um, it is, I have some cash sitting on the sidelines. Should I wait to invest it?
Yeah, that's a good question. Well, good for you if you have some cash coming into this. That's good, but it's a tough one to answer, right? It really depends on your individual circumstances and goals for the money, short term, long term, retirement, what you're doing with it. But in general, yes, it really is usually a good time to invest for the long term, right? As long as you are taking on the appropriate amount of risk for your specific situation by having a long-term investment plan invested at the right risk level. So that's really what matters. So we've designed portfolios that, given individuals' risk tolerances and goals for their money, are at the appropriate risk level given the current risk environment. So if we have you at the right risk level, then money coming into the market should be good for the long term. It kind of keeps you in the market and keeps you in the game. So again, knowing doesn't mean individual advice, but in general, yes, that if you're at the right risk level and have the right portfolio, you should be investing in the market.
Thanks, Chris. It looks like unless somebody comes in, we got one more. What would make you more positive or comfortable on market and risk right now?
Yeah, it's always a challenge, investing for the long term. We use multiple indicators, both internal, external, from our research partner at Danvers. They're really data driven based on historical precedent using a weighted the evidence approach. We have multiple rally watch indicators, bear market watch indicators that have 40 or 50 different components to those models. If you want to take a deep dive in those indicators, please give me a call. I'll be happy to walk you through them all. But really, the big picture level, they're all trying to get to the same, type of points. So when we're looking at previous downturns, previous sell-offs, what changed the narrative? What changed the performance? Well, there's a couple things you can kind of point to. Are we at attractive valuation, right? Are we cheap enough? Is all the bad news priced in? And once we kind of see that in attractive valuations, we can kind of move on into the next level and have that next bull market coming. Do we look for extreme positioning? Is everybody out of the market? Is everybody in cash? Is everybody looking to get back into the market, right? All those positionings that we look for outliers, not just the normal, soft or hard data, but are we really at extreme positioning in the market or out of the market? Also, we see policy support, right? Does the Fed come in and lower rates to try to support it? Do we see government step in and act? Is it just policy out there? And then lastly, just technical recovery, right? Those indicators out there from a technical standpoint that historically have proven to be turning points in bear markets before. So again, just those are the big four things we're looking for. But again, we have multiple models with, a whole bunch of data points looking at that I'm happy to walk through anybody if they want to. But again, looking for cheap valuations, extreme positioning, support from policy, and a technical recovery to get more constructive on the market. And we're just not seeing that yet.
Chris, thank you so much. This was so helpful. I just want to thank everyone who joined us this afternoon. We do host these webinars quarterly, so we'll be reviewing Q2 and kind of what's going on with the market. Come start the beginning of quarter 3, sometime in July. You can sign up for that right on our website at stonehearthcapital.com. And if you receive emails from us, we'll also remind you as we get closer for that. But in the meantime, thank you all for joining us, and we hope you enjoy the rest of your day.
Here, everyone.